A bit of calm before the storm and not much conviction in the trade. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Alex Steele. So one more day. And we'll finally get action? Is that what's going to happen?
I
Maybe?
hope so. Have you told Jensen Wong that?
Man, this market is tough. All right, let's get you checking in where we stand. The S&P is doing a whole lot of nothing, just up by 0.1%. Sure, it's at a record, but not that much to write home about. The NASDAQ and the NASDAQ 100 also at record highs. Some individual stocks I did want to highlight for you guys, though. Peloton down a whopping 15%. They're issuing some debt, 1,600 bips over LIBOR. That's a lot. That debt could yield about 11.5%. Ouch. And First Solar getting a nice upgrade here over at Piper Sandler. That company is saying they raised their price target, I should say, saying that stuff like IRA and all the government funding could do really well for stocks like First Solar. That's the best performing stock in the S&P and remain a little bit a bit into the bond market. Not a ton. Yields down by 2 basis points.
Well, you alluded to it, Alex. Quite frankly, the only stock that matters probably for the next 24 to 48 hours is going to be Nvidia. And while the markets remain subdued here on this second trading day of the week, strategists over at Goldman Sachs, they actually say investors are preparing for a spike in volatility later this week, particularly after Nvidia reports earnings on Wednesday. Now, the quarterly report out of Nvidia is, well, for many investors, going to be less about Nvidia itself and, quite frankly, more about the sustainability of that broader AI spending boom that is fueling sales of chips, of servers, data licenses, and so much more. Strategists over at Goldman say that the recent drop in volatility, though, actually conflicts a bit with the signals coming elsewhere in the options market that does show a higher demand for hedges against sudden market declines. Now, get this. With the VIX hovering around 12 right now, that low implied volatility is prompting a lot of folks out there to, well, go bullish on some of those call options. We had at least one trader out there amass 30,000 upside call contracts for July at a 40-strike price. Now, while the S&P is at a record high, this suggests markets are a little bit less worried about a sustained drawdown in prices, but they are worried about a temporary spike in volatility. At least that's according to Goldman. And you have data from Citigroup that actually supports that view as well, also showing a bit of a lopsided but still cautious rise in bullish positioning levels. And maybe that's why we are seeing some of those, quote, bearish signals out there start to flip maybe to a little bit more bullish. Mike Wilson, of course, was one of them. That was all the talk on Monday, him flipping his bearish view on stocks this week, boosting that target for the S&P to 5,400 points from 4,500. That takes his forecast from the lowest on Wall Street to one that projects a fresh record for the index. And there's a big question out there right now, Alex, is whether that switch is really a stance here that will be proven right, will be proven in the returns, or is this going to be another one of those contrarian calls that never really comes to fruition?
Or do we just need to kind of forget about strategic outlooks altogether in the short term?
I don't know.
I don't know.
You're going to put a lot of people out of work with that attitude,
That's true,
Alex.
and I don't want to do that because you guys are awesome and you come on the show and we love you. But this is why I say that, because the blue line here is the year-end 2024 S&P Wall Street forecast, and the white line is the S&P. And you can see here, the S&P is 9% above the average analyst forecast for this year. So how helpful are these forecasts actually going to be unless we see some kind of drawdown? Now, the question becomes, when do we get that kind of drawdown? What would that kind of drawdown look like? JP Morgan is kind of a lone holdout at this point, one of the few that hasn't upgraded their forecast. They're still at 4,200. How do we get from here to there? What's going to be that catalyst? Will it be an Nvidia, or will it be persistent inflation, or are we just going to grind higher here until something materially changes that calculus, Romaine?
Yeah, one of the big questions of the day, of the week, of the month, and quite possibly the year as we kick you off to the close here on this Tuesday afternoon. Andrew Slimmon joining us here on the big program, Senior Portfolio Manager and Head of Applied Equity Advisors over at Morgan Stanley Investment Management. And Andrew, I think this really is the question here. I mean, we have stocks more or less at record highs with the S&P, the Dow, and the NASDAQ hovering there. And everyone really kind of wants to know, I mean, is there a catalyst out there that could sort of materially move this market higher? Or is this pretty much it? I mean, we got our gains for the year. Should we just be happy and walk away?
Sure. I mean, I'm certainly happy on the year so far, but I think the catalyst is really, number one, the capitulation of the more bearish views coming from Wall Street. But what has not capitulated yet is all that money sitting in the money market. It's my view that the reason why there's so much money sitting in money markets is because of the perception that 5 to 6% of the money market is a very attractive return. That is a classic case symptomatic of early stage of a bull market when people have very low expectations. The later stages of a bull market, people expect higher returns, and 5 to 6% is not very attractive. So I think the fuel to keep the market, at least for now, pushing higher is really that the money that comes off the sidelines. And that's, classic fear to greed cycle. And to me, it just says we're still in the fear stage.
Well, it gets to a question then. You talk about that being the fuel, but sort of what opens that spigot here? I mean, if people are looking at the, 4 to 5, maybe even 6% that they might be getting, and they don't think that they can find anything comparable, at least on a risk-adjusted basis, what changes their view? Is it just further gains in the stock market and it becomes a FOMO, or a drop in yields where they just aren't getting the same returns? What?
Not dropping yields. FOMO, 100% FOMO. The market's up 20% last year. If we keep going higher, it's the FOMO. I am completely convinced that the only thing that's going to get people off the sidelines is ever higher returns for stocks. Doesn't mean we can't have, pullbacks along the way. I think there's one coming this summer, but I think that is the fuel to keep this market pushing higher. And basically what you're having is you have a situation where earnings are coming in strong and the inflation prints continue to come down. So that justifies people saying, well, maybe I should get a little bit more optimistic.
It definitely feels like that would lead to some serious blow off top, though, if you wind up seeing all that money market funds flow into the equity market. What's a good way to play that? I mean, do you need to look at options as a way to play that upside? How do you deal with it?
Well, I don't think it's all going to come in, Alex. I don't think it's all going to come in at once. Everyone has a different, kind of fear to greed monitor. But I think it goes back to the original question: what is going to drive it? And I still think that there are plenty of stocks out there that are pretty reasonably priced, especially on the financials being one. So as people search around for areas that have kind of lagged, I think the cyclical still will attract more money, because I haven't seen, other than a little consumer weakness, I just don't see the economy really slowing down. The market's screaming that. Metals and mining are doing well. You've got a lot of the cyclical stocks that are semis are doing well. I mean, these are groups that wouldn't be hitting highs if the economy was about to roll. Credit spreads are tight. So I think it's that's the area people are gonna buy into.
Okay, so you like cyclicals. You were mentioning semis. So that's a growth play. Where's the valuation with the growth play?
Well, look, what's happened in the last month or so is that we got a good, obviously we've had some good inflation prints, and so now the market has pivoted to Fed can cut. Rates are coming down, and that's kind of spurred the growth over kind of value trade recently. I think when we get to the summer, I think the inflation prints are going to get tougher to show better comparisons, and maybe that's when the market starts to say, maybe the Fed is not going to be cutting, and that's when you get a little pivot back into the value names, again, assuming the economy stays strong. Versus growth.
I am curious. I mean, what type of names do you find attractive right now, Andrew? Because we talk about this idea that for those folks that are invested, want to stay invested, or are looking for an entry point, there's still this crowding that we continue to see around the big cap tech stocks, even though I know there has been a little bit of a pull into some of those value names, into some of those cyclical names. Are you part of that group?
Yeah. So like, for instance, the insurance, we like Progressive. Well, Progressive is a company that actually likes higher interest rates. So as rates have come down a little bit recently, it pivoted into the growth. That has underperformed, although their business is very strong. I think the asset management, wealth management business is very attractive. So a stock like Ameriprise, for what we just discussed, which is as money comes out of the money markets, it's going to go into higher returning assets. That's good for the wealth management industry. And then a third area that I think is following fiscal spending. Where is the government spending the money? infrastructure. You look at these big industrials that are tied to infrastructure. So CRH is a cement company. They're raising prices. The government is taking those price increases. So I think there's plenty of reason. I'm not saying, hey, avoid tech. I'm just saying there are other areas that are doing well beyond just the AI tech trade.
And you're certainly seeing a lot of money try to find those pockets. Andrew, always great to talk to you. Going to have to leave it there. Andrew Slimmon, Senior Portfolio Manager and Head of Applied Equity Advisors over at Morgan Stanley Investment Management here on this Tuesday afternoon. On Monday, we had 5 Fed speakers today. We've already gotten 5 more, and there's 2 more still on tap before the day's out. We're going to tell you about what some of them have to say, including Fed Governor Christopher Waller.
Yep. All right. Plus, what Macy's CEO Tony Spring told Bloomberg's Romaine Bostick about the health of the consumer and company's turnaround prospects after beat profit estimates in the last quarter.
And we're going to talk to another CEO, the co-founder of Whole Foods, John Mackey, out with his memoir, Insights on Leading Whole Foods for 4 decades, and a talk, really, about the future of the industry. All that and more coming up in just a bit. This is The Close on Bloomberg.
Season is here.
This is a get out the popcorn moment.
And across the board, just pummeling of expectations.
Earnings matter. That's really clear.
Bloomberg is first to break the numbers.
Hey, folks, we've got Microsoft.
Apple earnings crossing the wire.
Alphabet, wow, coming in way above expectations.
Hertz driving in the opposite direction.
A lot still to come.
With the smartest insights.
Meta's kind of damned if they do and damned if they don't.
Is this their iPhone moment?
I view this as Operation Kick the Can to August.
Continuing coverage on Bloomberg. Context changes everything.
It's the week of Nvidia. It is the week of retail earnings. So Macy's stock is now up by 3.4%. It's been a pretty volatile day for the company after it did beat estimates. It had solid guidance, but the consumer question is still percolating among some of these retailers. Romaine, you talked with the Macy's CEO, Tony Spring. This is his first quarter, right?
Yeah, so he was on the last quarter. Obviously, He took over in February, so the last quarter really wasn't his quarter, even though he had to report it. But I talked to him on the phone this morning, just as the earnings were coming out, and they really touted the idea of what's going on in terms of beauty, skincare, and fragrances. We should point out they have 3 big businesses, right? They have Macy's, which we all know. They have Bluemercury, which is their skincare cosmetics brand, and then they have Bloomingdale's. Bluemercury is really where all the growth is right now, 4.3% comp sales. Macy's had negative comp sales, and Bloomingdale's was barely 1%.
Remember my point? What's my point? Invest in your face.
Well, and he's on this, and he goes even further. He's like, invest in your smell, invest in your odor. He was saying, look, like when you talk about the consumer being challenged, and he was very serious about this. Mm-hmm. He's saying, look, the consumer's being much more selective in what they buy, particularly on discretionary items. But he seemed to be of this attitude that they will spring for, things that treat yourself, whether it's face creams or fragrances, which he says have done well. And they said they're really going to lean further into that and expand their line of products in that space.
I like that. Invest in your face. Invest in your smell. That's my new thing. Okay. Now, what did he say, though, about the broader consumer? Is it like the low-end, high-end situation that we hear a lot about, like in the likes of Walmart, or is it just the selective buying?
He kind of put them all in the same kind of selective, but we should point out, he did talk about luxury shoppers, and this is more in the context of Bloomingdale's. He said things were going great when it came to women and apparel, women and shoes, not necessarily with men and not necessarily with some of the other categories here. So I think he is seeing pockets of strength, but like I just said, with the fragrances, it is kind of concentrated in very specific areas. Maybe that's enough to sort of help them with this turnaround plan, but at least for right now, that's all they got to really hang on.
And what about activist investor Arkhouse, right? I mean, does this give him some breathing room on this?
He seems to think so.
Okay.
We should point out there are 2 members of the board now that are from Arkhouse, and he still has to contend with that. There's still an offer on the table to buy this company and take it private at $24 a share. This is a stock right now that is trading around $19 to $20 a share. So, he's got to somehow address those valuation issues at some point, and it's not just going to be about, what sales and profits he brings. It's really about a long-term strategy.
Right. Here's my other question.
Yeah.
Did he mention inventory at all, and will there be sales good enough to let me to buy at Bloomingdale's?
Don't count on too many more promotions. Inventory levels are higher, but he said those inventory levels are higher because they anticipate selling more products, blah, blah, blah. Here's one thing, though, I thought he said was interesting. You know what he said fiscal 2025 is, which is the year we're heading into right now, that their big focus is going to be? Home furnishings.
Really?
Yeah, he says basically all the things they want to do with apparel, they're going to kind of be done with that in terms of some of the changes later this year. And they said the big pivot, the big focus is going to be on home furnishings.
That's interesting.
It was interesting. He didn't expand on that, but I'm very intrigued by it.
I don't usually go to Bloomingdale's or Macy's for home furnishing, but I'm going to have to.
Yeah, they have a big footprint for it. And he says that they're going to sort of lean deeper into that, expand the number of brands that they have, and hopefully make a go of it. But we'll see.
Interesting.
I don't know.
Okay. Well, good conversation. It was good stuff.
Yeah, good stuff and a pretty decent quarter. Investors seem to like what they've heard. Meanwhile, another stock that has been moving and fluctuating lately is Apple. Finally returning to its winning ways. We're going to talk about what's fueling the optimism for the stock that's coming up next here on The Close on Bloomberg.
South Africa's most important election since the end of apartheid focuses on infrastructure challenges, economic growth, and political fragmentation. Bloomberg's Jennifer Zabasaja reports live from key battlegrounds in Johannesburg, Cape Town, and Durban.
We think that South Africa is an exciting part of the world.
South Africa is a thriving and vibrant democracy.
There's a lot of expectation for the election.
Coverage begins May 27th on Bloomberg Television. Context changes everything.
All right, time now for our top calls. The big movers on the back of analyst recommendations, and we're going to start today with Caesars Entertainment. Raymond James starting coverage of the hotel and casino company with a strong buy and a $55 price target, saying despite messy first quarter results, still considers Caesars his top pick in the sector and expects improved results through the rest of the year. Those shares higher by about 2% on the day. Next up, let's take a look at Brinker International. You know it better as the owner of Chili's and Maggiano's, the big restaurant chains. An upgrade to buy from hold over at Argus, which sees profit growth accelerating to a double-digit rate over the next 3 years. The analyst there also touts the valuation given that the shares are trading at a discount when compared to their peers. Nevertheless, the shares taking a leg lower here, down about 0.4%. And finally, let's take a look at Toast, getting cut to neutral from outperform over by the analyst over at Baird. The price target set at 28, with the analyst citing a balance between risk and reward following the run-up in the shares this year. He also says that the restaurant software platform should be weary of slower location growth in the coming quarters. Those shares down about 2% on the day, and those are some of our top calls. All right, let's stay in the sell side space. Take a closer look at Apple, the behemoth, the giant here. Well, the stock, believe it or not, all year long has been in the red on a year-to-date basis, but that's changing right now. Right now, it's up just fractionally, about 0.1% on a year-to-date basis, but a return into the green, a reflection here of a shift in optimism around this company and around this stock. Ryan Vlastelica joining us right now to talk a little bit more about this. Bloomberg News reporter covering this stock. And Ryan, explain to me here why we're now, just now, starting to see a bit of a turnaround in sentiment. What's going on?
Hey, good afternoon. Thanks for having me on. So I say that Apple had two primary bear concerns that had been pressuring the stock throughout 2024. First one was just concerns about its growth rate. Where is the next leg of growth going to come from? Then on a related note, what is its strategy with respect to artificial intelligence? Now, it's done a pretty good job over the past month or so of addressing both of these concerns. It gave a very strong earnings report, and as part of that, it announced the largest buyback program in U.S. history, $110 billion, so just astronomical, a real sign of their ability to generate just incredible cash flow, and it did signal a return to growth going forward following some quarters with a little bit of weaker trends. At the same time, it has helped to ease some concerns about where it is with respect to AI and its strategy there. Bloomberg has reported that it has been in discussions with both Alphabet and OpenAI about implementing some AI features to the iPhone, and it's going to have an event next month where it's going to detail the strategy a little bit more. But there's a lot of optimism that as you start to incorporate some AI features, someone called it a Siri on steroids, that you're going to start to see more and more people willing to upgrade, and that's going to generate even more growth for the iPhone.
Ryan, how much of the pressure that we've seen on Apple this year do we attribute to AI versus China?
Well, China's been a huge headwind for the company. There's been a lot of reports about weaker iPhone sales there. So that's been a real central concern. Obviously, the iPhone is still its biggest product category by far, generating just a huge amount of revenue there. So there has been some concerns about that. But just the fact that it was a sensation that is not being, at the forefront of AI, especially with respect to Microsoft and Alphabet and some of the other of the Magnificent Seven. They're just kind of, add to the concern that especially if China is weaker, where is the growth going to come from? And it doesn't seem like they had too strong of a plan for AI.
There's a broader question here, Ryan, and I don't know if you can answer this or not, but there's a big question here as to sort of what actually drives growth for this company. There's been a lot of talk about how this stopped being a growth stock a long time ago. We don't have the type of innovation that we had seen in the past. It's basically just more iterations of the iPad, of the iPhone, and I guess if they incorporate AI, that gives a boost here. But is there any talk, any chatter here about needing maybe that next big new thing, if not the Vision Pro, the car, all these other projects that they have either flopped or abandoned? Is there anything else out there?
Well, the real hope is that AI is going to serve as that new growth driver, and it's going to be a real accelerant to, say, services growth. Now, again, we don't know a lot of the details about how Apple is going to incorporate AI into all of its products, but there is a hope that maybe people are going to be spending more on the cloud, spending more on all the various other kinds of recurring kind of revenue streams that it makes with the services. But you're absolutely right that the kind of growth that they're seeing is very far from the kind of growth that you're seeing at, say, Microsoft, for example, or Alphabet, or some of these other ones that have, the major hyperscalers that have these, very profitable cloud businesses. Apple is not exactly there, and it's not seeing that kind of growth for sure.
Hey, Ryan, we really appreciate you jumping on with us. Bloomberg's Ryan Balestica joining us. We also think your shirt is really cool, but we want to know what's on it. All right, speaking of Apple Romaine, Comcast is out with new streaming bundle with Netflix, Apple TV Plus, and its own Peacock service. It's going to cost $15 a month when you add it onto your existing TV or broadband internet subscription. I can't keep track.
Didn't we do this like in once in history?
Right before, and then it was called cable,
right?
And then we undid that to go to streaming.
Comcast has decided this is how we survive, just bringing back the bundle. I mean, look, in fairness to them, we should point out at $15, it is cheaper to get that bundle than to buy them separately, all three. Of course, I assume that price ain't going to stay at $15.
No.
It's just like, remember the old days in your cable bill? You always had that great introductory rate, and then it just kept going up and up and up until you threw a tantrum and threatened to quit, and then they're like, okay, maybe.
We'll just knock that down. Yeah, just wait until they start the non-commercial one. Then that'll be a whole different thing.
The interesting thing about this, though, and this actually dovetails into the question about content as well. And there was another story I saw. This was on Pixar, of course, the Disney studio. Mm-hmm. Cutting about 14% of its staff.
Yeah.
And there's been a lot of questions, too, about these streaming services and how much content they're producing, how good that content is, and whether it's worth paying for.
Yeah, anecdotally, my daughter works for Disney, and she's a freelance now, but she says it is tough out there to find a job. There are so many people unemployed at that point. All right, coming up, we're going to talk more about the Fed officials speak throughout the week with Julia Coronado joining us. This is Bloomberg.
Just about 3:30 p.m. in a very warm New York City. This is the countdown to the close. I'm Romaine Bostick.
And I'm Alex Steele. Is it warm out? I haven't been outside all day.
Yeah, it was warm out when I came in to the office, Alex.
Excellent.
And we haven't had warmth in quite some time, at least not at this level. So I'm loving it.
You're loving it. He's loving it. So apparently there were 19 Fed speakers this week.
Yeah.
Did you know that? 19? And this is counting like the same guy who
maybe
did a panel and an interview, an individual speech.
On the thing. Are they allowed to do this? I feel like, why? 3 times in a week?
I mean, I don't know.
And have you seen that Bostick guy? No relation, but I feel like he's spoken like 12 times this week.
He 1, 2, 3, 4. There's like 6 times that we're going to hear from Bostick this week in some form or another.
His throat must be getting hoarse.
Maybe a little bit. My favorite though was President Waller. Governor Waller said that he gave the April CPI a C+. I thought that was nice. I like it when they give a grade. I can understand it. It's been a while since I've seen a C.
I once got a C+ and I was grounded for like 3 months.
I never got a C. It was.
Of course you did.
I never got a C. It was always stressors. B+ was even bad. Okay, anyway, the Fed meeting is out tomorrow. Minutes meeting are out tomorrow. Officials seem to be on the same page about needing more data before rate cuts can come into play. We've heard from many officials so far this week.
We still need to finish the job. And we need to get all the way back down to 2%.
I need to see several more months of good inflation data before I would be comfortable supporting and easing in the stance of monetary policy.
Anything can happen. My outlook is really that inflation will continue to fall through this year and into 2025.
For me, at least, that means that we need to sit tight where we are for longer than we had previously thought. And I think we're in a good place to do that.
I was on the record before saying I was at the median, which was 3. The developments I've seen in the economy right now, I would not think that that's still appropriate because the inflation risks have moved up.
Let's get the take on the ground with Julia Coronado, president and founder of Macropolicy Perspectives. Julia worked for the Federal Reserve Board of Governors in Washington for 8 years, where she regularly briefed the board and contributed to the FOMC forecast. You're also at this Fed event at Amelia Island. I hear there's going to be a bar event after dinner. Look forward to that. Julia, do you get the sense that all the Fed officials are somewhat unified in the messaging that's coming out?
Absolutely. There's a real mantra right now. That mantra is policy is in a good place. It is well positioned to respond to risks in either direction. So they're kind of setting the bar high for any contemplation of hikes, just because they've had a few months of not so great C-plus inflation data. But at the same time, they're not in a rush to cut. And that, timing yet to be determined. TBD, depending on the data. Waller needs several more months. So we'll see what the June baseline is. Is it 2 cuts? Is it 1 cut? But ultimately, at the end of the day, it's a resumption in inflation progress. The tilt is still towards lower rates over time, but there's no rush.
Which, Julia, raises the question, as Romain was sort of setting up for us at the top of the show, right? I mean, markets are subdued. Volatility is subdued. Strategists are throwing in their forecasts and upping their S&P forecast. Is all of that consistent with a Fed that is higher for longer, but eventually a cut at some point?
There's a tension in the data right now, and that tension is, yes, there's plenty of evidence that higher rates are starting to take a toll on the economy, on the real estate sectors, on the banking sector, on durable goods demand, on pricing power by firms, retailers, et cetera. So we see the impact of tighter policy on the consumer, on inflation. But we also have this remarkable development in AI and technology that's really driving a lot of optimism in the stock market. So the stock market's sort of on a different plane than the real economy. Now, at the end of the day, there have been times when we've seen that. We saw that in the late 90s. This is not the Fed's job to regulate the stock market. It is the Fed's job to bring inflation down. And so that's what they're kind of focusing on. If inflation comes down, then they're going to cut.
I am curious, though. I mean, Julia, you've been at this conference, and I'm curious, are they obsessing over this stuff the way we obsess over it in the markets and in the media? Because, we talk about it. No? No?
No, they're definitely not. They are actually in a good place. Think about the trade-offs they're looking at. Oh, my goodness, we have to wait a little bit longer because the economy is still so resilient. It's not like we have a real inflation scare. It's just less progress than they had hoped for at this point. Inflation is still coming down globally. Inflation expectations are anchored. So really the trade-offs for Fed officials are pretty good. And they're thinking at this conference, a lot of the focus is on more structural issues, financial stability issues, the regulatory issues. These are bigger picture things that they get to think about when the trade-offs are relatively
Well, one of those bigger picture issues, and certainly more of a longer term issue, and I thought, and these were comments coming out of Raphael Bostic at the Atlanta Fed about the neutral rate. And there's been a lot of discussion here about, the neutral rate. Is it real? Does it exist? If it does exist, where should it be? But he seems to really be making the case that at least there needs to be a more honest discussion about it and where it should be here. How do you feel about it right now? Do you feel that it's something that is tangible, at least from a monetary policy making perspective?
So, Chair Powell does not find that concept particularly useful in setting policy in real time. So right now we're in a situation where, sure, the data are telling us that the neutral rate is higher, probably higher. But right now we can't tell the difference between whether the neutral rate is higher or that there's just longer lags in monetary policy. That's been a theme in Fed speak, that the lags from higher rates to housing inflation, from higher rates to the economy through the financing channel are longer than they expected because of all the fixed rate financing that was locked in during the pandemic. So that slows down transmission. That doesn't mean that as people have to move, as companies have to roll over debt, they will face higher financing costs under either, regardless of what the neutral rate is. So there's every anticipation. That's why they're not in any kind of panic about turning around and thinking about hikes. We are in a higher rate environment. We are in a much tighter money environment. Banks have tightened standards, credit channel, delinquencies amongst consumers are rising. There's a lot of indications that policy is starting to creep into the real economy. It's just taking longer. So yes, neutral's probably a bit higher. Also, the lags are a bit longer right now. The distinction between the two is you can't tell in the data which one is, and it doesn't matter. The policy prescription is the same. Patience, just wait.
Julia, in the meantime, when we wait, we have crazy things that happen like a meme stock rally. Financial conditions are still very loose. We have record high after record high on the S&P. And I'm just wondering, do those things signal anything to Federal Reserve officials or no?
Not as much. Again, when the translation from financial conditions are many things. Financial conditions are mortgage rates, which are not easy at all, and have in fact frozen the housing market, so that's not an equilibrium. At the same time, there are things other than interest rates that are driving the stock market. The median consumer is really the one setting inflation. And what we are hearing, what the Fed is hearing, they say this in the Beige Book, is that consumers are price sensitive again, that firms don't have the pricing power to pass everything through like they did during the pandemic, and that the frequency of price changes is slowing down. Prices are very flexible. You're not seeing any kind of wage price spiral. So there's a lot of things that tell them, no, policy is having the intended effect. If we're in a productivity boom that's driving the stock market, that's non-inflationary growth. The Fed doesn't need to regulate that.
All right, Julia, always great to talk to you. Julia Coronado, president and founder of Macropolicy Perspectives out there at Amelia Island at that big Fed conference. Look, I think the idea that all these Fed speakers are at least kind of on the same page actually is kind of encouraging for once.
Yeah.
I mean, you may not like the direction or the lack of direction that they're taking rates, but at least, there's not as much ambiguity as maybe there was, 8 or 9 months ago.
Right, exactly. So they're all eventually on the same page. But I do think that's interesting that, say, stimulus from Washington that's growth, right? And that isn't something that the Fed necessarily has to regulate, which really pairs with Andrew Slimmon talking about that cement maker, right? That they have pricing power and they have the demand. And I feel like maybe that's the trend, right? Like that growth is okay. That price input's okay because it's not necessarily something that is inflationary in the way that the Fed's worried about.
Is it possible that everything is okay? I mean, I know we in the media, we have to make a story out of this every day, but to a point that the Fed members, at least at this particular conference, aren't obsessing over it. And I figure they wouldn't, but it kind of gets to the question as to why the market is sweating it if the Fed isn't.
Right, the market isn't sweating it.
All right, a lot more coming up here on the show. We're going to talk about some of the big movers out there. One of the biggest movers in the S&P today, the biggest mover is First Solar. It is our stock of the hour. An explanation when we come back after the break. This is The Close on Bloomberg. All right, it's time now for our stock of the hour. A closer look at shares of First Solar, the biggest gainer today in the S&P 500. This after Piper Sandler and UBS raised their price targets on the solar and clean energy company. Piper Sandler noting that a barrage of new policies under the Inflation Reduction Act here in the U.S. providing a bit of a positive catalyst. Abigail Doolittle joining us for more on this. A 6% jump in the shares. We should point out the shares have been on an upward trajectory for a while now as we've started to see some of these Biden administration proposals and policies that would benefit the solar industry come into play.
Yeah, that really started last week, especially with the expansion of tariffs. But today there's a number of headlines, and I think that's the reason we have this big pop up, the best since March, the highest level since August of last year, within this uptrend that you're talking about. And I think that the biggest one, I believe, is UBS saying that their earnings could expand by 370% by the end of 2027 on big tech and AI. That big tech and AI, as they need, it's much more expensive. AI uses 10 times more electricity, that big tech will be looking for other sources of information. They're talking about Microsoft, Google, Amazon, all of these players, and apparently under 100%, they are under 100% renewable sustainability policies, so they would agree buy this through what are called PPAs. But the big point here is they think that in 2027, First Solar could be putting up $37 per share in adjusted earnings in 2027 versus the $7.74 in this year. That's a big, big leap up.
Yep, that's the demand, that's the supply, and the PPA's power purchase agreements, that's where all the demand is really going to be coming from. And there's also the AI case as well. And this has been, I've been pounding on this drum that utilities, maybe they're a growth sector rather than a defensive sector because of this AI play, really drawing on the energy.
Yes.
Did we see other sort of upgrades on that at all today?
That's a great point, Alex, because that is one of the hottest themes right now. And I'm going to look right now very quickly as I go through the XLU. The utilities, which you always think of as defensive, and the fact that they're rallying, you would typically see that as a sign that the markets are going to top. But there's so much talk about the idea that it is all about AI. So I don't see any upgrades under individual names here, but that sector, the XLU, that SPDR ETF, up 0.7%. So really going right along for the ride.
Yep. All right, Abigail, thanks a lot. Really appreciate it. Bloomberg's Abigail Doolittle joining us on that. And Bloomberg NEF had a report out that said we're going to have to spend an extra $34 trillion on the clean energy transition between now and 2050 to reach those goals. That's a lot of money. All right, we're going to count you down to the closing bell on this Tuesday. Amanda Agati is CIO over at PNC Asset Management Group. She'll be joining us next as we wait for Nvidia T-minus 24 hours. This is Bloomberg.
This is the countdown to the close. I'm Romaine Bostic alongside Alex Steele with about 10 minutes until we get to the closing bell. Stocks kind of hovering around those record highs, but really not doing much of anything. You've seen some of the tech stocks get bid, but this is really like one of those days where I think everyone's waiting for one particular company.
Totally agree. Yeah, you got tech, you got the NASDAQ 100, and the S&P at records. But the reason why we're at a record for the S&P is utilities are the best performing sector within the S&P. I just want to keep pointing that out because I think it's quite interesting as maybe there's a sea change there happening for that sector. But then you also have copper at yet another record high. I think I've lost count as to how many record highs there have been in copper just in the last week. So that still speaks to like a cyclical play, or maybe it's a structural thing. Maybe it's just consistent more money, whether you're looking at the Infrastructure Act, whether the IRA or AI, it's all the same idea. Money sloshing around, having to build stuff.
Absolutely. And of course, it's also seeing bids come into some of the soft commodities as well as precious metals too. Here on this Tuesday afternoon, as we move closer to those closing bells, we kicked you off to the close just a little while ago with a conversation with Andrew Slimmon over at Morgan Stanley. And we asked him what will be the fuel for the next leg of this equity market.
It's the FOMO. I am completely convinced that the only thing that's going to get people off the sidelines is ever higher returns for stocks. Doesn't mean we can't have, pullbacks along the way. I think there's one coming this summer, but I think that is the fuel to keep this market pushing higher. And basically what you're having is you have a situation where earnings are coming in strong and the inflation prints continue to come down. So that justifies people saying, well, maybe I should get a little bit more optimistic.
All right, Andrew Slimmon there talking about what could propel this market higher. Amanda Agati joining us right now, CIO over at PNC Asset Management, to help us count you down to those closing bells. And Amanda, we talk about what could propel this market higher. A lot of people looking to tomorrow after the bell, Wednesday night, when Nvidia reports, third biggest stock in the S&P 500, and one that a lot of people think could actually be a real catalyst for a broader market rally. Does that stock have that kind of juice?
It's great to be with you. Thanks so much for having me. And I have to say, I think it does have a bit of juice there to kind of break us out of somewhat of a range-bound or sort of choppy pattern that we've been in with the market. I mean, I recognize that the market is sitting at pretty elevated valuations and we've had strong returns on a year-to-date basis, but I am struggling for what is the catalyst to keep this rally going. And Nvidia certainly is top of mind in terms of one of those key juicier items to get the market going in one direction or another. I have to say the expectations are quite high. We continue to set the bar higher and higher and higher for Nvidia. So it's not like it's going to be a layup tomorrow, but it does seem as if the demand continues, pretty unabated at this point. And in and out of quarters, they continue to put up the fundamental chops to justify, this quasi-monopoly valuation level. So we're definitely focused on the results tomorrow in terms of the catalyst into the summer here.
And there are a lot of people also focus on this, less because they're interested specifically in Nvidia, but they really want to see whether there is true substance and a true foundation to this rally that we've seen on the back of AI. And I'm curious, as an investment manager yourself, whether you're sort of looking at AI and all the components that go into it and seeing it as a true investable opportunity well beyond just, say, the Nvidias and Microsofts of the world.
Oh, absolutely. We are total bulls, if not secular bulls, on all things AI and automation. And you're hitting on the key point that, I think investors are pretty short-sighted and very focused on one name, Nvidia, or maybe 5 names in total in terms of the way to play this. And we think it's a much bigger, broader story. The use cases, the innovation cycle that's going to be born out of this applies across all the sectors, and in particular across all the market capitalization. And so we really think, utilities are having a run here. A couple of weeks ago, I was talking to Tim and Carol on Bloomberg about utilities as an AI play. We do think that they are a key beneficiary of it, but it's not just utilities. It's really across the sector and across the market cap spectrum. Any company who can leverage this technology to enhance and improve their processes and ultimately drive margin expansion can really win in this environment at a time where I think margin expansion is somewhat limited. We're sort of hitting the upper end of margin expansion. In fact, for the S&P 500, we're off the peaks of profitability. So we do think that this could create sort of that next leg of profit margin expansion from here. It's just going to take time to materialize.
Amanda, we talked about how average analyst forecasts are 9% below where the S&P is currently trading. I technically look at a chart of, say, the 250-day, 100-day moving average for the S&P, and we are so far extended yet again. Technically, how are we set up right now?
It's a little bit of a precarious place. I don't want to say that I'm overly bearish in this environment because I'm really not that bearish. But from a technicals perspective, we are certainly overdue for a bit of a breather here. We didn't really have much of a sell in May and go away, right? Given where we are in terms of market returns here. And so I do think that given where valuations are sitting today, it doesn't leave us a lot of headroom for this market rally to continue to advance until we start to see a broadening in terms of earnings growth and earnings reacceleration. There's still a very big distinction between the Fab Five and everybody else, and we need that everybody else to start reasserting itself. We didn't really get that out of Q1 earnings season, but I do think by the time we get to Q2, we may actually start to see some of that movement. That would be great for the market at these levels.
So it really does think that a buy the dip in those sort of thematic plays that you're talking about, like that's just the way forward. It doesn't mean we're going to go straight up, but it does mean the buy the dip is here to stay. Is that a fair assessment?
I think I would be very comfortable saying buy the dip. I'm not sure how to quantify what the dip actually looks like because it doesn't seem like we're going to get much of a dip. I mean, we had just such a very slight correction in a matter of like 18 days. We were just shrugging that off and forging new highs. So I'm not entirely sure what the dip means in this environment, but I do think we will get a shot at some better entry points as the year progresses. It's just going to continue to be a bit of a choppy year, and we do think it's
yeah. All right. I think we're going to have to leave. All right, Amanda, we're going to have to leave it there. I think we're having some problems with their audio connection. Our thanks there to Amanda Agati, CIO over at PNC Asset Management, with about 3 minutes until the close. And even though our audio got cut off there, I think we got the gist of what she was saying is that a lot of people are looking for those entry points and those opportunities, and she sees maybe an entry point up ahead.
Yep, and sort of the structural factors that are kind of underpinning that, which really pairs with Andrew Slimmon talking about the FOMO. So you have kind of both. You're going to have the FOMO trade, and then you also have these longer-term structural changes that mean that you do want to go in and buy the dip.
Yeah, I just wonder where that money goes. Does it flow into the tech stocks and the old reliables, or does it go for, like Andrew Slimmon was talking about, more into some of the cyclical and other names that a lot of people have ignored?
Yeah, you know where I stand.
What, utilities?
Utilities and cyclicals, man.
Copper.
Energy,
right.
you know
We
it.
got that as we move closer to the closing bells. A lot moving here on this day, from commodities to bonds to stocks. Stick with us. We're taking you to the bell and beyond.
The Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Alex Steele. We're counting you down to the closing bell. Here to help take us beyond the bell, it's a global simulcast. Scarlett Fu here in the TV studio, Carol Massar and Tim Stenovic in the radio booth as we welcome our audiences across all of our Bloomberg platforms, as well as our partnership with YouTube to parse the most crucial moments of the day here, Carol Massar. And S&P 500 at a record high here on this day, although a modest record high.
Why are you shaking your head, Carol?
Well, record high, but
she's
man,
a disbeliever.
It's super boring.
She's a hater.
I'm just going to say, I'm not a hater. I love, but it just feels a little bit boring. But what was interesting is Abigail Doolittle was in our studio a little while ago and just pointing out that it's interesting that you've got record highs like on the S&P, you see the NASDAQ 100, moving up again. And you look at something like the transports, which continues to be under pressure, and divergencies in different parts of the market. You do wonder what it means when maybe everything isn't more trending in the same way, if you will. I don't know.
We just spoke to Gina Bolvin over at Bolvin Wealth Management Group, and she made the point that, yes, everybody's waiting for Nvidia. And she actually said that Nvidia has replaced Jay Powell as the market mover.
Whoa. And then she went, dun, dun, dun. No, she didn't.
What do you guys think?
I mean,
for 24 hours, maybe?
No, I don't know. No, it still has to be the Fed in the direction of the Fed longer term, no?
Yes, longer term, because what the Fed says determines where bonds trade, and that determines how much you're willing to pay for equities. But right now, people are willing to pay all kinds of things for Nvidia because it's the future.
Tim, who said that?
Gina Bolvin over at Bolvin Wealth Management Group.
So Gina Bolvin over at Bolvin Wealth Management Group out of Boston. I think she's wrong.
Do you?
Yeah.
All right, well.
There you go.
The Fed still matters, right?
Well, you know what they say about opinions.
Well, you asked my opinion, and you got it.
That's how you make a
All
market,
right, there's how we get the closing bells here in New York on this Tuesday afternoon. Green across the screen, at least for the three major indices, with the Dow Jones Industrial Average up more than 60 points, or about 0.2%. The S&P 500 looks like it is going to close at another record high, 53.21 and change. As we wait for these numbers to settle, that's about 13 points higher, or 0.2% higher than where we were yesterday. The NASDAQ Composite up about 37 points, or 0.2%. Similar move on the NASDAQ 100. Again, those are record highs. But as you alluded to a little bit earlier, still seeing some softness in the cyclical space. Dow Transport's down 1.7% here on the day, and the Russell 2000 closing out the day lower by 0.2%.
Right. We saw the transports below their 200-day moving average. So, for those technicians, certainly something they keep a watch on. S&P 500, back to the big caps we go, guys. Almost an even split in today's session. So 246 actually gaining some ground in the Tuesday trade. Scarlett about 253 lower for unchanged.
All right, let's take a look at the sector performances. And it's a mixed day overall, even as 7 industry groups are higher. A lot of green there. And in fact, the best performers, utilities, up 1%. They're kind of a play on AI, Alex, as you've been talking about for a while, because they get to generate the power that all those big computer networks and data centers eat up. So utilities gaining about 1%. Staples and financials up by at least half of 1%. Your laggards, energy, industrials, and REITs.
All right, guys, let's get to some of the individual gainers, if I may. And interestingly, Tesla is your number 2 gainer in the S&P 500 today, and it's the number 1 gainer in the NASDAQ 100. And I was kind of having a hard time kind of finding any real news. The stock finishing the day just off its highs of the day, but still with a 6.7% gain. Morgan Stanley's analyst reiterating Tesla's an overweight, making the case in a note to investors that Elon Musk needs Tesla more than ever before. As investors question if the CEO's commitment is less or more, we believe Elon needs it more than ever before. Also, what was interesting, and Benzinga Pro is putting this out, talking about how Tesla increased its 72-month loan rate in the United States, saying that is a positive sign for EV demand. So from about 0.99% to 1.9%. So I don't know. Does that mean that that is a positive? Anyway, a real outperformer. So kind of struggling to find a clear, definitive reason why, but nonetheless a real standout in the trade. Also a standout to the upside, Dollar General up about 3.5% in today's session, and this again was among top gainers in the S&P 500. Number 4 gainer in the S&P, as I mentioned, up 3.5%. This is as Citi's analyst came out and said there's no sign of a traffic slowdown at the dollar store operator. He rated the stock a neutral. And then one more, Macy's. I gave that actually for you, Romaine, a little bit of a gift, because I know you talked with the Macy's CEO today. But anyway, Macy's was up about 5% in today's session, beating profit estimates in the most recent quarter and raising its outlook for the remainder of the year. So maybe giving the CEO some breathing room. I don't know. What did you get from your conversation, Romaine?
Well, they've really focused on those first 50 stores that they keep talking about, the ones they think are going to be the prototype. That's where the growth was, Carol. I mean, if you took those 50 stores and separated from the rest, that's 3% growth on a comp sales basis. You put those stores back in with the other 300 plus stores here, and you got negative growth.
Big difference.
There it is. Yeah.
So that's where the growth is. All right, that's the gainers.
Okay, how about some decliners? I do want to start with Palo Alto Networks, falling today by 3.7%. They fell after the company reported earnings after the bell yesterday. They gave a downbeat forecast for the current period. It renewed concern that there's going to be a slowdown, or there has been a slowdown when it comes to cybersecurity. Once again, shares falling by 3.7% today. And shares of Children's Place plunging today, down 20%. It's a kids apparel retailer, got $150 million market cap. It's a small company, but it is down 97% since 2017. They announced that longtime CEO Jane Elfers has left the company. They've named Mohammed Umair as interim CEO. Elfers has been at the company going all the way back to 2010. Before that, she was CEO at Lord & Taylor. And even though shares fell 19.5% today, we can go ahead and round that up to 20%. It's only its worst day going back to February. So it shows how recent big moves have hit the company's stock.
Do you not shop there, Tim? Don't you
I
have
don't
small
shop
kids?
at Children's
Yeah.
Place. Yeah, we're
No,
all about.
because their clothes fall apart
We're-
after 3 uses.
I don't know. We haven't shopped there. We're all hand-me-downs. There's so many people whose kids are just older than ours, and we just get the free
circular
clothes.
economy.
Yeah, it's all.
huge.
I don't even know where any of this stuff comes from, but it just shows up. And we dress our kids in it. It's fine. Shares of Peloton also falling today, down by 16%. They fell after the company said on Monday that it's doing a global refinancing, which includes selling $275 million of senior convertible notes that are due in 2029, and then entering into a new $100 million revolving credit facility. Also, according to our own Bloomberg reporting, the company kicked off the sale of a $1 billion loan offering as it works to refi existing debt and recover from a recent slump in sales. This, according to a person familiar with the matter.
Did you see the interest rate, though?
Yeah,
They're shopping around.
11.5%.
Yeah, so they're at 12% on that. And I was
Yeah.
looking at the previous. I mean, they were basically servicing around like 2 to 3, and then they had the convertible notes, which were at 0%. I don't know what they're doing here, man.
Yeah, loan to carry interest at 600 basis points over the SOFR rate.
Yeah.
I mean, that's a lot.
Yeah.
Which makes the yield you're getting in the bond market not that exciting. But again, that's kind of risk-free. So taking a look at the bond market, you're seeing yields a bit lower, a bid pretty much across, particularly in the back end. I'm just really looking at the 10-year in particular because last week when it kind of broke below the 50-day, we kind of been bouncing around between the two. And kind of what's going to break us out of that range? Governor Waller said that the CPI for April was a C+. So if we get an A, does that kind of change the trajectory? I don't know.
I want to make a quick comment, though, about the rates, because you kind of were joking about it. But we were talking, I don't know, it was Andrew Slimmon or someone we were talking to earlier about the competition between the rates that you get in the bond market versus what you can make in equities. And that's what sort of lead to sort of the FOMO here. But I think people forget, too, it's not just about what you're getting in money markets or in treasuries. I mean, there's a lot of corporate debt out there where you can get comparable results. Now, I'm not saying Peloton is it, but there are plenty of others out there where you can get high single digits and even low double digits without necessarily going into public equities. So.
Yeah, but it's so tight. The spread is so tight. Anyway, sorry, Scarlett.
Sorry, I didn't mean to bring the party to a halt here.
I was looking at Urban Outfitters earnings because they have just come out. The specialty retailer announcing profit and sales that beat analyst estimates. First quarter, let's see, comparable retail segment sales up 4.6%. Analysts were looking for an increase of 2.9%. And first quarter adjusted EPS 69 cents. Analysts were looking for 51 cents on average. The stock up by 8.5% right now.
Yeah, stock up 16% so far this year. So it's interesting, going to build on that gain. That's a huge pop, man.
Yeah,
that is a big pop.
The company CEO said that it was driven by continued strength at Anthropologie, Free People movement, and Nuuly brands. Consumer demand remains robust for spring and summer fashion, which bodes well for continued sales growth in quarter two.
So this is also a stock that some analysts wind up really liking and some investors because it's like a specialty retailer. Like it knows what the customer is, it knows how to execute, and it's not like a broad store, say like a Macy's or like a Target or a Walmart. It's very specialized, and sometimes that's good. Sometimes that's bad, and apparently I've been talking to some portfolio managers who like that kind of idea now for Urban Outfitters.
Well, it knows its customer, and it doesn't have to please everyone, which is proving pretty impossible when there's so much uncertainty and when your customers are segmented so much, right?
Yeah, it's very clearly defined. I agree with you, and right, so they know as long as they kind of get the product mix right, and their customer stays true, like they seem to.
Which is not us. Maybe Tim, but not us.
I like anthropology.
Hand-me-downs. Romain gives me his old clothes that I can wear on air.
It's fair enough.
Still hasn't taught me how to tie a bow tie, but
no, it's coming.
Yeah.
I have to teach you how to tie a regular tie.
I'm looking for that too.
He's never got a tie on. All right, that's a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. We will see you again, same time, same place tomorrow.
All right, stick with us here on Bloomberg Television. A lot of great conversations coming up here on the close, including with John Mackey, the co-founder of Whole Foods. You definitely want to hear his insights on the 4 decades that he ran that company and, well, what he's doing right now. That's coming up in just a second, right here on the close on Bloomberg.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romain Bostic. Another day of somewhat tepid price action, but
record high?
Action may have been tepid, but as Scarlett said, it's still a record high. And you know what? Sometimes you take the wins as you can get them. 53.21 right now on the S&P 500, a gain of just about 0.2%. But we also saw the Nasdaq as well, also climb back to fresh record highs. A lot could change here over the next 24 hours. Of course, about 24 hours from now, we are going to get that big earnings report out of Nvidia. Elsewhere, though, there was a lot of activity. We saw a big downdraft today in the transportation average, the Dow Transports, with that led largely by trucking stocks as well as railroads, which took a huge leg down. But to the upside, we saw aluminum, we saw copper also continue to extend gains. Aluminum having a phenomenal day. And then keep an eye on Ether. There's a bunch of applications out there that the SEC is supposed to approve for an Ether ETF. Just a couple days ago, it looked like the consensus was that wasn't going to be approved. Now, some optimism here that could come to fruition. Ether up about 7% here on the day. But meanwhile, Scarlett, we go back to the individual market, and there were some big winners there.
Absolutely. Let's take a look at the best performer in the NASDAQ 100. That would be Tesla, closing up 6 2/3%. Morgan Stanley reiterating its overweight rating, but at the same time, there's a group of shareholders urging others, to reject the $56 billion pay package that the board is now seeking investor approval on. The group says that Elon Musk, the CEO, is distracted by the 5 other companies that he controls, and he's not really serving the car maker's best interest. So we'll keep you posted on those developments. In the meantime, you also have Nordson, one of the big decliners here, off by 9.4%, plunging the most in 14 months. The industrial company makes adhesive systems, and it cut its full-year sales and profit outlook. What's going on is it says electronics customers are not yet following through on their planned purchases, and a weak agriculture cycle, the pressure from that cycle in Europe, is causing other customers to slow down their investments as well. Now, our top story this hour is how inflation is changing our preferences for everyday needs, such as cosmetics, food, and drinks. When it comes to alcoholic drinks, U.S. consumers are increasingly willing to seek out new labels. According to a recent Bloomberg Intelligence survey, brand loyalty matters most for beer and wine, but has become less important for spirits. And one reason why: aggressive price hikes imposed by the producers over the past year. The survey found taste is the most important factor, followed by price, alcohol content, and then brand.
All right, Scarlett, well, it's interesting you bring that up because we did have a chance to sit down with the founder and CEO of a spirits company, and she talked a lot about, well, trying to maintain prices in order to keep customers happy. The brand Uncle Nearest, one of the top-selling black-owned spirit companies in the world, and we just learned today that it is expanding, announcing today the acquisition of vodka maker Square One Organic Spirits. Fawn Weaver, she is the founder and CEO over at Uncle Nearest. Here's what she had to say about her drive to become the first spirit conglomerate to be founded by a woman or person of color.
There's never been a spirit conglomerate that was founded by, owned by a person of color or a woman ever in the history of this country. And so when Uncle Nearest began to grow, I realized that we're vulnerable at staying independent if we don't have what the big guys have, which is an ability to trade on margin. The cost of Uncle Nearest is much greater than the cost of vodka, of Square One vodka, in terms of the product itself. And so the big guys had an advantage over us because they had other products that they could play with margin and that they can say, hey, case of Uncle Nearest combined with a case of Square One, the price together is a lot lower, right? And so they had that advantage, and I wanted to make sure that we did as well.
When you talk about sort of building a conglomerate to compete in that space here, I mean, let's just face it, that's a very ambitious statement.
We're doing it, though.
And you are so far, but we've seen so many other liquor brands pop up, and the trajectory has always been the same. Build it up, make some money, get the attention, and then sell it out to Diageo or Brown-Forman or whoever. You're not planning to do that?
Absolutely not. That's the reason why we're building it ourselves. We said from the very beginning, we would be the acquirers, not the acquired. And this industry, for as long as it's been around, you're set up as an independent coming in. You have two options before Uncle Nearest. You either fail or you sell. It's the way the distributor network is set up. It is the ability to have trading on a lower cost and things of that nature. And so if you see a brand, they rise up, most of them aren't selling because they wanted to. Most of them are selling because they had to, because of the way the industry is set up. So in order to protect Uncle Nearest, in order to make sure that we could do what we set out to do, which is to build this company so that 200 years from now, it is still growing. We didn't have an option of just staying as Uncle Nearest as a bourbon brand. We had to go into vodka. We had to go into cognac. At some point, we'll have to go into tequila. And that is just the way our industry is set up. But no, we're not selling.
Okay, so tequila at some point down the road.
Way down the road. It's so oversaturated. I'm so uninterested in the category right now. I can't even tell you how uninterested I am in the category.
You also didn't like vodka until you did.
I didn't like vodka, and my team has loved vodka, most of them, and wanted us to go into the vodka space for years. And I just didn't like it. To me, it tastes like, smelled like rubbing alcohol. I said, give me a Band-Aid, put it on a wound. That's what you're asking me to drink. But I challenged them. I said, if you can find me a vodka that I like, we will go into the vodka business. It took them 4 years, and I think they had me taste everything under the sun. And we finally came across Square One organic vodka. And it was the first time I put it to my nose, and I said, oh, this smells clean. Like, this doesn't smell like it should be on a wound. This smells really good. But it wasn't just me. My chief business officer hates vodka or hated vodka, and so did our master blender. So the three of us had to be aligned in a vodka that we love the nose and we love the palate. And until Square One, we hadn't come across, and we've been doing tastings for 4 years straight.
Now, your company does not have any institutional investors. You have a lot of individual investors, wealthy individuals.
We do.
Some special purpose vehicles comprised of wealthy individuals investing in your company. So when you went out to purchase Square One, you didn't have to consult with your institutional investors, get their okay, get their sign off or anything like that. In order to stay independent, what else do you think you need to acquire? What else do you think you need to add to your portfolio to do that? Are wines or beer in your future?
No, currently just with the three, we can do what we need to do with the three, because each of these have the potential to be so large and so significant and massive players. When the cognac comes out next year and people, once they see, we begin filming with Jeffrey Wright to tell the remarkable true story of cognac and our American roots. Most people don't know the American roots and the reason why we are the #1 consumer of cognac. America is. So once we begin building those three, we're good.
It's interesting you bring that up, and particularly with the Jeffrey Wright angle.
Yeah.
Because when Uncle Nearest came out, I think one thing that really aided sales of that and the attention it got was the backstory.
Absolutely.
And obviously a very rich backstory, and maybe one that most of us didn't know, or at least not know the true story.
Yeah.
Do you have that, though, with the other brands?
Absolutely. Yeah. I would say when the cognac brand comes out, I think that there will be people that will say that backstory, that history, is even better than the Uncle Nearest story, because that history it is pulled from all over the world. And the amount of research, the amount of money I spent on researchers around the world to pull this story together, no one knows the backstory of cognac. No one knows why America has long been the #1 consumer, and why African Americans, Black Latinos make up 75% of the consumption in this country of cognac. There's a reason for that, and nobody knows it. So when Jeffrey Wright tells that story, I just approved the final script a couple days ago.
Yeah.
When Jeffrey Wright tells that story, not only is it going to blow people's mind, but you're going to see America choose cognac as one of their top spirits moving forward, without question.
Storytelling is obviously such a big part of this industry. I want to talk about the story of the economy right now, because some people describe it as K-shaped. The wealthy are doing just fine. They're growing their wealth, while the lower income population is struggling with high costs and persistent inflation.
Yeah.
If that's the case, how are you folding that in as you position Uncle Nearest?
Yeah, well, the thing that we've done with Uncle Nearest is when a lot of the larger brands, when alcohol was selling like crazy during COVID, they went up on their pricing. I held. I said, this is where we're going to stay, whether the economy is up or down. We have a sweet spot, and we're not going to take advantage of consumers just because they're buying more and we know we can. We are going to hold. And so in everything that we have done, we're looking at it and saying, listen, whether the market is up or the market is down, do we have a price point that our consumers can buy at? The answer is yes.
And that was Fawn Weaver, founder and CEO of Uncle Nearest. I thought it was interesting that she said, we're going to hold prices. If you're a publicly traded company, you don't have that luxury.
Yeah, well, good thing she is it. So I guess she has that luxury. But it gets to the broader question, too, is like, you kind of were setting this up on the inflation thing. I mean, let's face it, for some people, alcohol is more of a staple than a discretionary item.
Good point.
But, I mean, it does question, like, how much pricing power do these brands have? Particularly given, look, I've had it. It's great whiskey, but, there are tons of other whiskeys out there as well that are probably just as good at a comparable price.
Well, at this point, for Uncle Nearest, it's in the position to benefit from people being willing to shop around because they're kind of fed up with price hikes on their consistent brands. So now it's a case of like, let's look around. Maybe I'll find something better, and I'd be willing to pay up for something that's new.
The one thing that you didn't ask, and that I didn't ask you, Scarlett, is are you a whiskey drinker?
No,
You're
it
wine,
burns
beer,
the throat.
What are you?
Wine.
Wine?
Yeah,
okay.
wine all day.
All right. Well, I like bourbon and rye.
Of course. That
what about
ties.
tequila? Apparently she hates tequila.
I know. She was like, no way, I don't want to go near that.
No way. Oh, my gosh.
She's very, very clear on that. Coming up, we've got the top three, where we focus in on the top three movers and shakers at the center of the day's big stories. This is The Close.
South Africa's most important election since the end of apartheid focuses on infrastructure challenges, economic growth, and political fragmentation. Bloomberg's Jennifer Zabasaja reports live from key battlegrounds in Johannesburg, Cape Town, and Durban.
We think that South Africa is an exciting part of the world.
South Africa is a thriving and vibrant democracy.
There's a lot of expectation for the election.
Coverage begins May 27th on Bloomberg Television. Context changes everything.
It's time now for the top three, where we name drop the people driving some of the day's most talked about stories. And first up, Scarlett Johansson. The actress says she was forced to hire legal counsel to demand the removal of an AI voice for OpenAI's chatbot that sounded a bit too much like her. This is life imitating art, because, of course, she started her as an AI virtual assistant.
Yeah, you can't make this up here. And all I'll say is kudos to her and her lawyers. I haven't actually heard this thing, but if the story, the narrative that they're putting out there is true, that they approached her about this, she denied it, and then somehow they still ended up with AI voice like hers?
Yeah.
No bueno.
Yeah, no bueno. And watch out. You don't want to be on the receiving end of a ScarJo lawsuit.
Yeah, well, maybe some of us would, actually. Ron Perlman, someone I'm keeping an eye on as one of our big three people of the day. Ron Perlman, of course, the financier, of course, ran Revlon for years, had been on the hook. He owed about $1 billion, and he was using Revlon shares as collateral. Revlon shares collapsed, so he had to sell a bunch of artwork. We knew that. We did not know what he sold. Now we're learning from some unsealed court documents that from 20 to 22, he sold about 71 pieces, and these were big pieces. We're talking about Basquiat's and Twombly's and Giacometti sculptures, just a whole trove of things here that he was able to raise like $900 million to pay, I guess, presumably to pay some of his
What's
creditors.
left then? That's what I'm saying.
Well, that's what I'm saying. I was going through this list here, and first of all, this is an impressive list, Scarlett. Picasso, Basquiat, Pollock, Andy Warhol, Roy Lichtenstein, just the list goes on and on and on here. And it lists the actual titles here if you want to go through it. But great story on the Bloomberg terminal here about some of what looks like maybe a forced sale of some of these assets.
And little of the money actually went to him, right? It went to his
this all went, according to the story, all went to his creditors.
Yeah, almost $1 billion worth. Okay, finally, the last person we're watching is Bob Iger, the Disney CEO, finding more ways to cut costs. His latest move includes cutting 14% of Pixar's staff. And of course, Pixar made Toy Story and Finding Nemo, but its latest theatrical release was Elemental right after the pandemic, during the pandemic, did not have a great U.S. opening.
Is this going to backfire on them? I was always under the impression that these types of animated films almost required a tremendous amount of people power to do. And I know there's new technologies and maybe even AI that can maybe create some shortcuts here. But I don't know, when I hear 14%, I think that seems like a lot.
That does seem like a lot. So I'm guessing AI plays a big role here where you can just automate a lot of it.
Yeah, gotcha. All right, when we return, Scarlett Fu, we're going to take a look back at Whole Foods and a big decision that it made 8 years ago this week to think small when it came to the size of its stores. And here's a question before we go to break, an easy one maybe. How many locations does Whole Foods currently have?
I'm going to say a couple thousand.
All right, well, we're going to have the answer when we come back after the break. This is The Close on Bloomberg. All right, it was this week back in 2016 when Whole Foods, the organic grocery chain that had been stung for years by a lot of snarky comments about its high prices, began experimenting with smaller stores that specialized in cheaper private label groceries. Called 365 by Whole Foods Market, it was an effort to demonstrate that, well, the company wasn't just for foodies willing to spend their quote-unquote whole paycheck on premium products. That first 365 store flung its doors open to much fanfare. It was centered in the hip Silver Lake section of Los Angeles. And at the time, the company had signed 19 leases for additional 365 stores, which were going to be about half the square footage of a typical Whole Foods. Now, that expansion of strategy came at a somewhat precipitous time. It was sandwiched on one side by an onslaught of competitors in the organic food space, and on the other side by Amazon's acquisition of Whole Foods just about a year later in 2017. Now, Amazon eventually decided that those 365 locations weren't performing up to their sales expectations, and by 2019, they began shutting them down or converting those locations back to regular Whole Foods. Now, several years later, after abandoning that lower-priced, small footprint store strategy, Whole Foods is taking another run at that idea and going even smaller. It's a concept called Daily Shop that's supposed to debut later this year in New York. It'll have about 7,000 to 14,000 square feet of space. Now, that compares to roughly 25,000 square feet that we had in those 365 stores and the 40,000 plus square feet in the regular format Whole Foods markets. The Daily Shop is supposed to offer a slimmer assortment of products with none of the buffet bars and meat counters that are standard in most of the other stores. We had a chance to catch up with the current CEO, Jason Beekle, a couple of weeks ago at the Milken Conference, and I asked him why they're re-experimenting with this smaller store concept again.
The consumer right now is wanting a balance of quality and value. And that's something that we've been really focused on as Whole Foods Market. One of the things that we're really proud of is the work we've done investing in our price points so we can be accessible to all customers. Since being part of Amazon, this has been a key initiative for us to help improve our price points. Recently, we've done a lot of work in helping also amp up the number of promotions that we're doing. We know customers right now are looking for value, so we've increased our number of promotions. We made investments in areas like our opening price point and like our 365 items. So customers have a great opportunity for value and quality at the same time.
And it's really hard to overstate just how much this company has evolved. All told, Whole Foods has grown from a single store in Austin, Texas back in the late 1970s to today, more than 500 stores, 538 if you want to be precise, as of the end of last quarter. And while its independence as a standalone is no more, it is still the centerpiece of Amazon's food and grocery strategy.
Great setup there. So joining us now is John Mackey, the co-founder of Whole Foods. He was CEO of the company for 44 years. And John has just written a book called The Whole Story, Adventures in Love, Life, and Capitalism. He is now pursuing his next business venture, a health and wellness company called Love Life. John, it is great to see you. And Romaine gave us a perfect setup. I want to go back to that moment when you sold Whole Foods to Amazon. The purchase was completed in June of 2017. And we know it's a $13.6 billion purchase, Amazon's biggest ever. Going back, what is the single most important lesson that you would draw from that experience of selling your company to Amazon?
What's the biggest lesson I learned from the sale itself? I'm not sure I learned any lessons from the sale itself. I mean, after the sale, or I learned that, people ask me, let me tell you the question people usually ask me, which is, do you regret selling to Amazon?
And
the answer is, I regret the circumstances that made that the best alternative for Whole Foods. And it was definitely the best alternative. If you go back to that time, Whole Foods was being harassed by activist investors, JANA Partners, and they were trying to force us they wanted to change our board, they wanted to change our management team, they wanted to put us up to sale for the highest bidder. And we looked at all kinds of different alternatives, from going private to maybe having Warren Buffett buy the company, to activist defense against the activist. And when Amazon came up as a possibility, we explored it, and that turned out to be the best alternative for us. And it worked out really good. And Amazon let us, one of the things when you showed the 365 stores, for example, well, Amazon let Whole Foods drop its prices 4 times in the first 2 years. In a lot of ways, those 365 stores were kind of redundant. They were too small, and they weren't very much less expensive than the regular stores. So there was really no need to keep them. We didn't get rid of them. We just rebranded them Whole Foods because they were that brand's better known than 365.
But to Scarlett's point too, you say to a certain extent you regret the circumstances. Do you ever regret taking the company public to begin with?
No. We couldn't have become who we were if we hadn't gone public. The access to capital was difficult. We needed it.
Yeah.
Was this an instance, each of those decisions, taking it public and then selling to Amazon, was that a case of your evolving or dying, or Whole Foods evolving or dying? Because I know that's a big theme in your new book, the importance of companies that kind of move quickly, pivot.
You have to evolve or die. So in both cases, we were evolving. We went public because we needed to raise more capital in order to grow, and that was the best way to access capital, was through the public markets. We sold to Amazon because we also needed to evolve in order to hold off the activist shareholders. So yes, both cases was evolution.
Is the ethos still there though? Because that was a big part of Whole Foods and all the iterations it went through. It attracted people that at the time didn't have a whole lot of options. You went to an independent store, you didn't really have the sort of the plethora of organic options that you now have that are now standard in Whole Foods and other competitors.
That's capitalism at work. You have a successful idea, people copy your innovations, and it's important. That's why you have to keep evolving. That's why capitalism is this kind of upward flowing game, where if you don't evolve and get better, you're going to get passed up. And so, people started copying us, and Whole Foods is still evolving.
You are a capitalist. You describe yourself as a capitalist.
I am definitely a capitalist. Capitalism is the best thing that's ever happened to humanity.
You know you have a lot of customers who would probably not describe themselves as capitalists and would almost see that as a dirty word. How did you balance that? Because you were appealing to a certain clientele that was probably somewhat opposed, at least in terms of the use of that word and the perception of that word. But you embraced it big time and you leaned into it.
I guess they could have gone shopping at co-ops if they preferred, but it turned out that the for-profit business model was a more vibrant business model. So I just don't think people shop at their stores because of the politics of the CEO. I think they shop there because a store's creating value for them, things they want, quality, services. That's what's really important.
Yeah, well, we heard earlier from the executive who talked about quality and value. In an era of rising prices and, inflation is slowing, but it's not going back to what it was pre-pandemic. In that balance of quality and value, which one does a for-profit company have to give up a little of in order to achieve the other? Which one is less important?
It depends on the strategy and the positioning of the company. So, Whole Foods, we put quality first. Quality was what we built our business brand around. And Walmart or Costco, they put their emphasis on value and price. So you have to have different strategies. It's like business is like a complex ecosystem, and there are lots of different niches in the ecosystem.
Well, to Romaine's point about, your customers maybe perhaps embracing a different ethos than a for-profit company, you talk about shared mission in your book as well. Is shared mission more important for a company's employees or mission with consumers and customers?
It's important to both. I mean,
but which one is more? I mean, you can't always.
Why do you have to choose? I mean, it's a win-win-win. If you create value for your customers and your employees, you should create value for all your stakeholders, customers, team members, suppliers, investors, the community we're part of. That's conscious capitalism. Business seeing the interdependency of all the stakeholders and creating value for all of them.
Do you feel like that's a widespread belief, though? I mean, what you just described. There aren't too many people publicly, at least of your stature in terms of in corporate America, saying the same thing.
The reality is, whether you like it or not, stakeholders are interdependent. In other words, they're flourishing or sinking together. If a business fails, all the stakeholders lose. As a business it grows and expands, that's good for all the stakeholders. So they are interdependent. And hey, I wrote a book called Conscious Capitalism, so yeah. I'd urge people to read that book too.
All right. You've got also a book called The Whole Story, Adventures in Love, Life, and Capitalism. John Mackey, got to leave it there, the co-founder and former CEO over at Whole Foods. Some breaking news we want to bring you. This on the home builder Toll Brothers earnings out here in after hours trading and their fiscal 2Q backlog. Well, coming in a little bit light, 7,093. The street was looking for roughly about 7,200. But we should point out they did beat on most of the other key metrics, including EPS at $4.55 a share, beating street estimates of $4.14 a share. And the guidance going forward, Scarlett, here for the fiscal third quarter in terms of deliveries, in terms of sales, and in terms of adjusted EPS, all looking like they're coming in slightly above what the street was looking for, shares higher by about 1% in after hours trading.
Yeah, I'm looking at gross margin, whether it's full year or third quarter. That's going to be slightly higher than the consensus estimate, and that's good enough for a 1.3% gain in after hours trade. All right, looking at the broader markets, record high for the S&P 500. But, one thing that is really notable, Romaine, is just how quiet it's been in the markets. The most impressive stat today on the relative calm, the S&P 500 has gone 313 trading days without a drop of 2% or more. The VIX is below 12, well below 12 at this point.
Yeah, and you think about some of the competing narratives out there. I thought it was interesting. There's a great note about the strategist over at Goldman Sachs taking a look at the VIX and saying there's actually a lot of positioning around this idea that we are going to see an uptick in volatility, but not necessarily a drop in prices.
Right. Well, speaking of setting up for something big, Nvidia due to report earnings tomorrow, up 2/3 of 1% on earnings eve. This is the close.
All right, black women spend almost $8 billion on beauty and cosmetics every year. Yet when you take a look at some of the offers in stores and online, the representation, it doesn't always add up. It's not always up to par. Black-owned and operated brands like Fashion Fair have been working to change that. Founded all the way back in 1973 by Eunice Johnson, the driving force behind iconic publications like Ebony and Jet magazines, and we should also point out, a Chicago-based company, Scarlet Fu. Fashion Fair was one of the first brands to sell darker shades in stores like Neiman Marcus and Primtemps. Here in studio with us is more on the brand's revival. Desiree Rogers, she's the CEO of Fashion Fair, and she's had a very long career in corporate America and in government. Also the CEO of the beauty brand Black Opal and a former White House social secretary in the Obama administration. Great to have you here in studio.
Thank you for having me.
All right, I always tease her. I'm from Chicago, so anybody from Chicago is always welcome here on the set. But I do want to talk about Fashion Fair. This is very personal to me. Growing up in Chicago, Fashion Fair was on every woman of my life. It was on every medicine cabinet. Not just because it was a good brand, but it was the only brand.
Outstanding brand.
It was a great brand, but it was the only brand you were going to get if you were looking for shades that matched our skin tones. A lot's changed since then. You have a lot of other options out there. Why reboot this brand?
So I think it's a couple of things. Number one, it's more than a makeup brand, it's our history. And I think it's really important that we maintain and create opportunities to have businesses that really are run by people that are buying the product. And so my business partner and I, Cheryl McKissick and I, we bought it out of bankruptcy because we really believe in the brand. It was my first makeup, and it's been reimagined. How has it been reimagined? We worked with a dermatologist on all of the formulations. We know about undertones. And so we were able to take that 50 years of work and work with Sam Fine, the celebrity makeup artist, to create the new line. And so I think it's important that we invest in businesses that are represented by people that look like us. And why would we let Fashion Fair's 50-year history just go to waste, so to speak?
Well, I am curious as to how you market this, because sort of one of the other big hallmarks of what Eunice Johnson did with the Fashion Fair, it wasn't just the fact that she had this line, but it was the way she promoted it, of course, the fashion shows. I mean, this is all pretty novel at the time. I know it's kind of standard now, but how do you sort of differentiate?
Not really, right? I mean, because one of the things, Fashion Fair is inspired by the fashion glamour and beauty of Black women. And so that's coming straight from Eunice. We just did a convention here in New York, and we recreated her boudoir. So it's filled with history. Who is that Fashion Fair iconic woman today? What is she reading? What is she interested in? Is she interested in politics? What fashion is she wearing? What bag does she carry? So we had all the name brands there, and a beautiful letter to Mrs. Johnson from Valentino and Givenchy. And let's not forget Stephen Burrows, a Black designer. And so just bringing that history to life is one fun way that we're differentiated. And just the products themselves. They've been reimagined, they've got natural ingredients, and we've got all of the history of what we think was doing it right. We've added one thing, we've added hot topics. And so what are hot topics? I don't think you're going to see many makeup companies that are thinking about what are the hot topics for Black women and minority women. And so our first project is with the American Cancer Society, and we are actually looking to recruit 100,000 Black women for research, because Black women are dying so much earlier, getting breast cancer before they're 40, and 41% of us are dying compared to our counterparts. And so you're going to see us continuing to choose a topic that's important to us and getting on board with that topic and really creating a space for women to have a conversation about that topic.
And serving your community at the same time. So tell me a little bit more about who your customer base is right now as you revive the brand. Is it the children of, moms who had, used it devotedly? Someone like Romaine Bostock-Pierre, for instance.
It's so interesting. I mean, I'm just coming from the boudoir over the weekend, and one of the things we know is women still don't know that we're back. So for 3 years plus, we were out of the market. And so the one thing that we're hopeful is that people realize we're back. We're sold at select Sephora's and Macy's stores, as well as fashionfair.com. And so the first thing is just people that knew us before to know we're back. So that's one group. The second group, as you mentioned, we want everyone. We want their daughters. My daughter is trying our products now, our blushes and our lip teasers. So it's really kind of a 30-ish woman. Just based on the ingredients that we are putting in the products. It's a little bit pricier, so it's in, the 35, 40 range. And so we think there's plenty of opportunity and plenty of people for us to talk to and to be encouraged by the brand. Plus, we have this great group of consumers that know us from before. And so they have daughters, they have granddaughters, they have sisters. And so we're excited to be able to represent and reimagine this brand that is so deep in the history of Black women in this country.
I'm glad
and was the first.
And of course, the first. That history, of course, precedes it. I want to go back to your mentioning price point, because this is Bloomberg, and we've got to talk about inflation and the economic environment. We know inflation's been kind of persistent. How are you thinking in terms of where you want to be pricing your products, and how long you can stay the line on where you price them before you kind of give in to increasing prices when the costs do go up?
Of course. So one of the things that we're cognizant of is we want to make certain that it's affordable. So we're not the priciest brand on the market, even though I would say we're some of the highest quality products on the market. And Cheryl and I have made a decision that we're maybe willing to take a little bit less margin to make certain that our community has access to this quality of product developed specifically for them. And so, yes, if pricing goes up on certain items, we're going to have to raise those prices. We are in business. at the same time, we want people to have access to the brand and be able to afford the brand. And, as people think about, why would you bring this more mature brand back? I like to say iconic. Mm-hmm. And I look around and I say, well, you've got on Gucci, you've got on Chanel, you've got on Dior. Why can't we have a makeup brand that was started by a black founder and now is owned by 2 black women, be the next Estee Lauder? What's wrong with that?
Then nothing's wrong with that at all. And if you can pull it off, it looks like you're already having some success with it. Desiree, this is a great conversation. It was great to have you on. I should also point out, Scarlett, that I think she is now officially the best dressed guest we've ever had on this program. Not that I would expect anything less.
You guys look good too.
Thank you. Desiree Rogers there, the CEO of Fashion Fair. All right, stick with us. We're going to set you up for what to watch tomorrow. And I'm told, Scarlett, there's one big thing everyone's going to have their eye on.
What, you mean the economic data point? Is that it?
Maybe that, or maybe Nvidia. Stick with us. This is The Close on Bloomberg. As we set you up for what the markets will be watching tomorrow, of course, one big thing is going to dominate, and that's the earnings out of Nvidia. Kunjan Sobhani, Bloomberg Intelligence senior semiconductors analyst, joining us right now for a preview of what to expect, and I assume that's going to include some pretty phenomenal revenue growth.
Yeah, we once again expect solid earnings coming into the quarter with a high likelihood of beat and raise. During the quarter, we have seen multiple signals that validate that the demand momentum continues to be strong. First, its largest cloud and hyperscale customers all have upsided their AI CapEx spending for the year. Second, its largest supplier also gave higher expectations of a high demand environment in the second half of the year. Mm-hmm. And third, we're also seeing strength in demand activity outside of just these cloud and hyperscalers, whether it's government entities, whether it's sovereign wealth entities and enterprises. So all of that sort of raises our confidence that this again will be a spectacular quarter.
And Kunjan, just very quickly, how much can investors read into what NVIDIA says and project out for what it means for the rest of the tech sector?
That will be a key point. We think from NVIDIA's commentary, positive commentary, the estimates on the street should go up for the rest of the year. Again, like I said, there could be some, I think, timing at play here, given that now they are shipping H200. There is the expectations of the Blackwell chips coming in towards the second half of the year, and you could see some temporary movements in customers sort of halting to purchase the H200 and waiting for the B100s. So we could see that. But again, for the story, it still remains intact.
All right, Kunjan Sobhani over at Bloomberg Intelligence. A busy day up ahead for him and a busy day for the markets as well. And we're actually going to start off on overseas with some of the other things to keep an eye on. That includes a rate decision out of the Reserve Bank of New Zealand.
Yeah, and it's expected to have a dovish hold. The Indonesian Central Bank is also holding its decision meeting, and they had raised rates back in October and April. So
yeah, absolutely. And then after we get that decision, you're going to get some inflation data over there in the UK.
Yeah, UK CPI comes out at 2 a.m. Eastern time. We'll keep an eye on what that means for the BOE.
Yeah, I assume you won't be up for that, but you will probably be up at 9:40 a.m. when we get more Fed speak. Austin Goolsbee, who I feel like already spoke, is going to speak again.
They've all been speaking a lot, and it's all kind of the lead up to the Fed minutes, which comes out at 2 p.m., where we'll get more of their thinking, individual members' thinking, and certainly in the lead up to the next Fed meeting where they actually give their economic projections. Yeah,
absolutely. That next SCP is going to be big. And of course, we go back to earnings because they are going to dominate tomorrow, and not just from Nvidia. We get a couple big retailers before the bell.
And we already know from Target that they're going to look to cut prices on a number of items, thousands of items this summer, because their customer is dealing with high prices and needs value.
Yeah, 5,000 items. That's on top of the 1,500 that they said they already cut. We're going to hear from TJX as well.
My favorite store.
Petco. And then, of course, after the bell, that's when the fireworks come. Nvidia, and I guess you could throw Snowflake in there as another tech company.
Yeah,
I don't think anyone's paying attention to
the big show
Snowflake.
is Nvidia. Come on.
All right. And, of course, we will have full coverage, better than no one else, right here on The Close tomorrow after the bell. Be sure to tune in for that. In the meantime, stick around. All your politics coverage coming up on Balance of Power.